Hi everyone, this is Dr. Tom Gerard again, and in this video, this is a follow-up into Chapter 1. We're in Chapter 1 of an Introduction to Financial Accounting class, and I wanted to get into transactions, which is covered in Chapter 2, but before I can do that, I need to get through some of the underlying assumptions and principles of accounting in general, because that's really going to set the stage on how easy the rest of the stuff is to understand. Sometimes people move through Chapter 1 and 2 too quickly, and then they're completely lost by the time they get into the latter chapters. But if you can get these concepts in your mind right up front, then it's really going to help you throughout the rest of the course. Principles. And we're going to talk now a little bit more. I introduced the idea of the accounting equation, and we're going to get a little bit more into that. And we need to look at these underlying assumptions and principles of accounting to understand how the accounting equation works and the transactions work that we'll get really more in depth in Chapter 2. Now, I did talk about some of these other things like the financial statements and things of that nature in the Chapter 1 video. So if you haven't watched that, go back and watch that. Okay, so let's do this, and let's see if I can find my spot here. And I've got to go through my PowerPoint and find out where we were at. So we're going to talk a little bit here about the assumptions of accounting, the process of accounting. So financially, accounting says, and GAAP, generally accepted accounting principles, are based upon the following assumptions. Now, obviously, I know you can read, but let's talk a little bit about this. These are the four things that kind of introduce you to the whole idea moving forward. We got monetary unit, which is how we record things. Money, monetary, right? Time is in what time period does this activity of doing business take place? The business entity, which we talked about quite a bit in Chapter 1, you know, whether you're a sole proprietorship or a corporation makes somewhat different. Also, the growing concern. You know, I always ask my introduction to business students in pretty much all of my classes, why are you in business? And the common answer is, I'm going in business to make money. And so then I always go to that whole story about the person that won the lottery. You know, they won all these millions of dollars and they're rich overnight. They made money, right? And then what happens? You read about them, and 6 months later, they've spent all the money and they're broke again. Some of them even homeless. You know, and you hear these stories. So really, this is true of business. A lot of people go into business, they put their life savings to get a business going. They're doing good, they're making money, and then all of a sudden something happens. In our case, just in recent times, it's been the COVID-19 pandemic, shut down many businesses and put a lot of small businesses out of business, right? And so what we're saying here when we say growing concern is that we don't want to just make money today, but we want to make money for the future, right? We want to continue to make money. We want to continue to grow and get bigger and stronger. And so I always use the analogy, you know, we want to be that person. And maybe you're a real young person in college, like I said, right out of high school. But you know what you want to strive for in business is like, I'm not just going to go out and make a lot of money today and, you know, live a good life, which, you know, I hope you all do. But the end goal of business is that someday there's going to be a statue of me out in front of this building that you are now the great-grandfather of these people that are running the business. Maybe you're long dead. But the point is there's a statue of you. You're the founder of the business. The business is still going generations to come. And that is what we want in business, right? And so that's what is a growing concern. So let's go back now. Let's see. And we want to talk about the principles. Okay, so principles is, and I want to go through these a little bit more in depth. Measurement, historical cost, revenue recognition, and expense recognition. Now again, a lot of this Obviously, you've probably heard the words measurement and historical, that kind of thing. You may or may not have heard people say revenue or expenditures. In accounting, that's just kind of our language, and we'll look at that in a minute here. Recognition is we say, well, you're going to get an award, you're being recognized. Well, the question is when is that happening? And that has to do with this terminology here. So let's go on. Measurement. So the measurement principle requires that amounts, so monetary amount, remember we said monetary amount, we're measuring this in dollars. In the United States, we're measuring it in dollars. If you're in another country, you're measuring it just like you do. Accounting is used around the world. It's used since many, thousands of years ago. But the measurement principle, the monetary unit is being measured. So what is it? It says the amount, how much money we're going to assign to something, is based upon independent evidence, and it is verifiable, and we're going to say, especially in the corporate world, is verified by confirmed by a third party. So what does that mean? If and think about, and a lot of times I use this analogy because most of us think about you're doing your income taxes and you get audited from an auditor. And really, an auditor is really what they're checking for is, can we verify what you've put on your tax return? And so let's just say you said, well, I've got 5 kids that I'm claiming on my income taxes. Well, they need to verify that you've got 5 kids, right? That you're claiming those deductions. And so they'll look at, okay, we need their social security numbers. We need to know how many months out of the year they've lived with you, this kind of thing. But it's true in business. If you said, well, I spent, and my example I use is the lawnmower, right? I spent $10,000 on this lawnmower at the lawnmower shop because I'm going in the lawn mowing business. And what is the auditor going to say? They're going to say, well, we need to see the receipts for the lawnmower, and we're going to see that you paid for it because, I got a piece of paper that says you got a lawnmower. But I need to see, well, did you pay for that lawnmower? And how did you pay for that lawnmower? So we're verifying the information. And that's very important, especially because many, I won't say most, but many young people, when they get their degree in accounting, the very first job they get is an auditor. And an auditor, remember, is not a law enforcement person. A law enforcement person is the FBI or the district attorney. They're the ones that are going to say you're doing something illegal. An auditor is to be able to check it and say, hey, there's something going on here. And if they believe there's something illegal, then they refer it to the law enforcement type agencies. But the auditor's job is to find it and verify it. By the way, that's another reason why, like I'd said in the first video, why there's so many great jobs in accounting, because one of the main places that hire accountants, and think about this, most people don't even think about this. One of the main agencies that hire accountants out of college is the FBI. Because the FBI knows that you got to be able to follow the money. If you're going after criminals, people are doing crime primarily for financial reward, at least in, most crimes. And so they need people that are trained in accounting. Now, those FBI agents are just like every other FBI agents. They go to the training facility and they carry a gun and they can arrest people. And all this kind of things, but they're accountants because that's how you catch the bad guys, right? Okay, so that's verifiable, very important, especially if you're going into auditing. And when you need to start thinking, especially if you're, I talk a lot about starting your own business because I know that is what a lot of people aspire to do, and I encourage you to do that. However, there's some people that just, that I'm going to go to work for a firm. I'm going to work for a company, maybe a company that I really believe in. I want to get a job there. And so when you get a job in accounting in the corporate world, you want to start thinking like an auditor. You want to think about, what people are telling me, because even within an organization, and we have a whole chapter on that, by the way, in the future, great jobs for internal auditors That's where I started in accounting, was as an internal auditor for a great big organization. Okay, the historical cost principle or cost principle. So how do, and again, some of this stuff, you read it and you think, oh, this is just common sense. But think about things that you've bought. When you buy something, you pay a certain price for it. And sometimes you'll say, well, did you get a good deal on that? Yeah, I got a good deal because, it's normally $100 and I got it for $80. It was on sale 20% off. Or, oh, I bought it for $100 and then 2 days later you find out somewhere else has it on sale and it's like, oh, I could have got that cheaper if I would have waited. But really, and so basically history means at what time did this take place? Well, I bought it for $100 and maybe tomorrow it's going to be 80, or maybe tomorrow it's going to be 150, right? It doesn't really matter. What this is saying, we're going to record this information, this monetary information, at whatever you paid for it. So it doesn't matter how much is it worth, or what we call market value. In stocks, it's the market, right? The stock market. And the stocks change almost on a moment-by-moment basis now that we live in the electronic world. But what you paid for the stock is what we're talking about here. So imagine you bought some Microsoft stock at this price, and 20 minutes later it's changed. It's a different price, and you either made money or you lost money. But the point is, with this is how much you paid for it. And that's what we're going to record it as. And that's why we got that verifiable thing. We can verify what you paid for it. I can't necessarily, now maybe with stocks you can, I can't necessarily verify what it's worth. So imagine somebody buys a classic car. I paid $10,000 and it's a 1968, Ford Mustang or something. And it's worth $20,000. Well, I can't verify that it's really worth $20,000 unless I sell it. But because it's really only worth what somebody's going to pay for it. But I can't verify that. I can't put that in my records, because really my records show, oh, this is what I paid. I paid $10,000 for it. So I know I'm dwelling on all of these things. But again, this first couple chapters is building upon what's coming ahead. So now the first thing we want to talk about is this idea of revenue. Revenue is the amount earned. Now I will say they've got in parentheses received. So we have to be careful. Now accountants call revenue. So let's just use this terminology, right? Regardless of what you think it means in your mind. This is what I have to say a lot, and especially when we get to debits and credits. We get to debits and credits and you have to put away what you've been thought or you think that means. So revenue is the amount earned from providing services or goods to a consumer, right? So now you can have lots of kinds of revenue, and we'll talk about this later. We got revenue because I mowed the lawn, right? And somebody owes me money. I earned it because I mowed the lawn. Maybe you're a doctor and you did some kind of medical procedure. You earned that. It's a service. You stayed in the hotel room, or you went to a concert. Those are kind of considered services because you consume it and it's over with, right? Maybe it's goods. I sold you something. So this is all revenue. Sales or fees, they call those. Services as fees, and goods might be sales. But we could have other kinds of revenue too, and we'll see this as we go on. Like maybe I have I loaned you some money and you're paying me interest. I have interest revenue. Or maybe I have a house that you're renting and I have rent revenue. I didn't really sell you anything. I didn't provide you a service. You're using my house and you're paying me rent, right? So that's a rent revenue. So different kinds, and we'll see that as we go. So the most important thing to know about this recognition is we're going to recognition it at the time that you earn it. And that's why, again, it seems simple, but in reality, accountants are always looking at this time frame. I recognize this revenue, I provided the service, and I earned it. I mowed the lawn, and now you owe me to mow the lawn. Now, whether you pay me or not, we're not talking about here. Okay, so this is why I want to say, take this word received out of here, because we may or may not receive the money for doing the service or selling something, right? But we earned it, right? So now let's go to the second one. And so you could follow in your thought processes. Expenses, again, is the amounts used to generate. That's an interesting definition. But these are really what we're thinking of. We owe somebody money. Their amounts. You don't say that we paid out money, right? Because sometimes I owe you a liability. Remember, we talked a little bit about when we first introduced the idea of the accounting equation. So as far as using money, because cash and money are a component of this. But let's say and I stay with my examples. I'm not, in this case, I'm not mowing lawns. I'm the swimming pool cleaning guy, right? I always like these little service business because, my career started in the exterminating business. And, and it's also, when we're talking about services, sometimes it's, it's a little hard to get your head around things, but it's really a good example for these beginning things. So let's think about this. So I'm going to clean swimming pools, and I got a swimming pool route business, and I go out, when I start, say it's day one of the month, I would go to the swimming pool supply store where I get all of my chemicals, and I say, I don't want to have to come back here after every swimming pool. So I could go clean a pool, go back and get more chemicals. If I'm working out of a, Toyota Corolla or something, I would have to do that. But no, this is my business. I can't do that. So I'm going to go to the store, the supply store, and I'm going to get a week's worth of chemicals. And maybe it's $1,000. I don't know what it is. It's not about the money. It's the concept we're talking about here. So now I'm going to go in once a week. I'm going to get a week's worth of chemicals to put in swimming pools. And I'm not going to pay the guy every week. I'm just going to say, I'm your regular customer. We have an account. We have an agreement. I'm going to come in every week, get chemicals. I might come in throughout the week once in a while because maybe I need something special or I need to get some more chemicals. I ran short or whatever. And I might come in periodically through the month and get some things, but I'm not going to pay you every time. I want to be able to just come in, get my stuff, you check it out, and then I'm gone, and then you send me a bill. And that's really the way business works, right? So think about even in your own home, you've got your electric bill. You don't say, oh, I turned on the TV, I got to pay the electric company. No, you pay your bill after the month is. So in other words, basically, so going back to what we're talking about here, the matching principle, sometimes called matching principle, is that when did you use these things, these swimming pool chemicals, to generate the revenue? Because so I went to Mrs. Smith's swimming pool and cleaned it. I didn't use $1,000. I say I got the $1,000 for the whole week. But in Mrs. Smith, I only used, $25 or whatever it is. And I'm just making all that up to make a point. And then I go to Mrs. Jones and I use $25. And then on it goes. And so when did I recognize this expense? Well, it wasn't when I went and got $1,000 worth of chemicals, because I walked out of the store with $1,000 worth of chemicals and I didn't pay for it, by the way. Do I recognize the expense then? Or do I recognize the expense when, next month he sends me the bill, it's 4 weeks, $1,000 a week, $4,000, and I pay him in a cash or check or however you're paying, direct deposit? Do I recognize it then? Or do I recognize the expense when I go to Mrs. Jones' swimming pool and I spent $25? Well, in the world of accounting, we use it at the time we provide the service. So if Mrs. Jones is paying me $100, and again, I'm making these numbers up just so I can do math, because like I said, I don't want people to think that accounting is a math class. It's really not. Understanding numbers and things helps. But what happens is, so maybe she's paying me $100 and I've only used $25 worth of chemicals there, even though I have $1,000 worth, even though I owe the person $1,000. I'm only using 25. So now, you begin to think, the reason why I'm going through this so in depth now is because you understand. I want you to go away from my class to understand, what does all this mean to me in my life? You know, it's like, oh yeah, you take an introduction to financial accounting and you learn all this debits, credits, you know, T accounts, all these things. We look in chapter 2. But what does this really mean? Well, it means this. If you're in business and you're cleaning a swimming pool and you're charging $100, how much does the chemicals cost you for that pool? Oh, $25 or $1,000? Because if it's $1,000, you just lost $900. So we're going to match it. And we say, okay, Mrs. Jones' pool cost me $25 in chemicals. It took me an hour of my time, right? I had to drive my truck and get gas in my truck, and my truck was $40,000. And if it wasn't for my truck, I would have had to walk. I couldn't walk to Mrs. Jones because she lives clear across town. So I have the truck. But I'm not saying that her swimming pool cost me $40,000 that I paid for my truck. See, so we're going to break it down, and that's what depreciation is. We'll get on to later. So we're going to say, well, what's the piece of the truck cost? What's the insurance on the truck? What is my interest on the loan that I borrowed money to buy the truck and the trailer? And what is the cost of the chemicals? And what is the cost of my labor hours that I think that I deserve? How much money do you make an hour? Well, it depends, right? Mrs. Jones, you might make 100, well, I won't say 100 because you only charge her $100, unless you're doing it in 30 minutes, you know. Maybe you make $100 an hour because you only spent 30 minutes, you charged her $100. It, you know, it cost you $50 in costs and you made $50 in 30 minutes. So thinking like an accountant and thinking about a manager in business, you're thinking about, how much does it cost me to provide this service? And that applies to everything. And I'm making it real simple, like a swimming pool or mowing a lawn, but it could be just as simple, just the same as if I'm Elon Musk and I'm going to take a spacecraft and send it into outer space and put up satellites. I don't, you know, all of that stuff goes, there's, you know, what is it, billions of dollars probably it costs to do that. But I want to know, how much is this one satellite going to cost me to get into outer space, right? And so that means, and these are a lot of things you cover in managerial accounting. And I'm going on, and I'm going to finish this because I'll have to do another chapter, another video on the transactions, because I want you to understand, why are we doing all this, right? So now I know I need to do this many lawns, or this many pools, or this many brain surgeries, or this many satellites in outer space to be able to build the company that I want, right? And you get to the point in managerial accounting where you start to say, well, wait a minute, if I'm only making $10 every time I clean a swimming pool, if I want to make $1,000 a week, it's impossible because I can't work that many hours, right? So that's kind of what that's all about. Okay, let's see if we can continue here real quick before we end. Try and keep this under 30 minutes. So we talked about the accounting equation, and we talked about, you know, assets equals liabilities plus owner's equity. There's the equation. Now let's break this. We talked about, in the last two slides, we talked about revenue and expenditures. Well, where are they at on this? I don't see them. Well, let's talk about, well, let me go to my stockholders equity. So let's talk real quick about this stockholders equity. Now, again, this could be owner's equity, or just even equity for that matter, but, you know, assets equals liabilities plus equity. So let's break down this equity and see what it composes of. Well, it composes of two things. The common stock. Now, this just means money we paid in. Some books you'll see it'll say owner's capital, because again, if I started my lawnmower business and I put my money into it, in the last video we talked about, I put $2,000 of my own money in, that would be common stock. I'd have that money in there. That's what I invested. If you're a big giant corporation, you know, like, you know, Facebook, when they went public, you know, they had millions of people putting in money to buy a piece of the company. But they put in that because why? They want to earn a return on that. So where do you get the return? Well, of course, on stock, you're getting the return on whether or not the stock goes up and down value. But really where it comes from is retained earnings. So let's just say, forget about the stock prices real quickly and talk about the owner's equity, because maybe this is my little lawn mowing business and I don't, nobody's buying stock in that, it's just me and this is my business. So where it comes from is retained earnings. Now, retained earnings is that whole idea of revenue and expenditures that we were just talking about. So it says here, common stocks is shares of ownership. And the other one is retained earnings is the equity created from the operations of the business through revenue and expense transactions. So we're going to talk about transactions, later, but the revenue and expenses that we just described, I've earned something and I had to spend some money to earn something, right? I had to buy the truck, I had to buy the lawnmower, I had to buy the chemicals to earn the revenue to do the mowing of the lawn or cleaning the swimming pools or sending the satellite in outer space, right? So retained earnings is that. So we start with remember we talked about in the other video, I started with my $2,000 I put into it. And at the end of the year, let's say, and again, it doesn't have to be year, but let's just say year, we've made, how much money did we make on our investment, right? So we invested the $2,000, and at the end of the year, let's just say we made $50,000. Then did we really get that much return on 2,000? Well, no, because I put in my man hour, and again, start thinking, especially even again, if you're a small business person, start thinking like a big company. Because if you said, oh my gosh, I put in $2,000 and I went out and mowed lawns or cleaned pools all year long, and I made $50,000. So I made whatever's that percentage of 250% or something. I don't know. But the truth is no, because you had to pay yourself, right? Did you work for free? Well, no. And so that's the way a business would look at it. So if you said to me, and if you ever watch the show Shark Tank, this is what they do. They say, how much did you make? And you go, well, I made $50,000. How much did you put in of your own money? $2,000. Well, how are you earning money, $2,000 to make it $50,000? Oh, well, that's because I go out and clean swimming pools all day long, 40 hours a week or 50 hours a week. Oh, okay. So that means that if you weren't in the picture, we'd have to pay somebody. Well, what would we have to pay somebody? Well, oh gosh, man, I'm working 6 days a week. And if I made $100 a day, that's $600 a week, but so then you begin to think, oh, wait a minute now. And then I got to pay insurance for you, and I got to pay for taxes, payroll taxes, which again, we get into in a whole chapter. So basically what you're telling me is you lost money on the $2,000 because you made $50,000, say, but now by the time we talk about all of your labor and all the other expenses that you're not accounting for because you're just working, you're taking the money out for yourself, you're really losing money. You probably lost $20,000 for the year, right? Oh, okay. Well, now we got a different story. And so now you're saying, oh, Shark Tank, oh, you want me to invest in your business and you're losing $20,000 a year? And you go, well, no, I made $50,000. No, you worked for the $50,000. So if I come into the business, somebody's still going to have to do the work. And if it's not you, we're going to have to pay somebody. Or if you're going to do it, you're still going to need $50,000 to live on, right? So start thinking that way, even if it's your own lawn mowing business. That's where I'm trying to go with this, right? How does this apply? Okay. I promise you we're almost done. So take a look at this. Now, here's my stockholders' equity, and you'll see that how does money go in and out of this stockholders' equity part of my accounting equation? Well, first of all, I put in the money, my $2,000, stockholders' investments, or whatever the original owners put it in to start it, their own money. And then I had revenues minus the expenses. Revenues means money up, and well, I keep saying money, but don't get confused. It's earnings, right? I earned some things, and I owe some things. I have some liabilities. So this net income, what we used to remember, I talked about the P&L, the income statement, the profit and loss. If I make money, it increases my equity. If I lose money, it decreases my equity, right? Now, there's one other thing on here that we haven't really talked about, and that is, what if I take some money back out? So I put in $2,000 in my business. I went it out and I started mowing lawns or whatever I'm doing. And then I decide, well, you know, I originally put my 2,000 in. What if I'd like to take that 2,000 back out and just let this revenue minus expenses, my income statement, support this business going forward? And you might do that if it's a small, you know, like I said, a very small business. And so that means a distribution of earnings to stockholders. And we call this dividends. And we can talk all day long and night about dividends, and we will get into dividends. But for our purposes at this point, just realize the dividends is a word that we're going to use when money from the business is being paid out to the shareholders. Okay, if this is just me and my lawn mowing business and I take out the $2,000, that's kind of like if I was a corporation, a dividend, right? My income would be my payroll, right? If I made $50,000 mowing lawns and I'm paying myself, that's going to have to be payroll. But if I put $2,000 in and then I take the $2,000 out, that's not part of my pay, right? That's not part of my salary. It's part of what I invested and I'm just taking it out. So that's different. And quite frankly, that is why the IRS, for income tax purposes, treats owners' distributions or dividends, tax-wise, differently from the way they treat your earnings income on your payroll and your W-2 income. Okay, so I'm going to stop now. I know I've gone way too long. I was hoping I'd get to transactions, but we'll continue another video for that. But this is the foundation moving forward. It's very important you understand the components to this accounting equation and what makes it up. And so now we've learned that. We've got assets, liabilities, equity, which is made up of dividends, contributions, and revenues and expenses, all under equity. Okay, thank you, and watch the next video we're going to do on the transactions. I promise we're going to get to the transactions. Hi, this is Dr. Tom Gerard real quick, and I want to thank you for watching the video. If you stayed this long, that's great. Like I said, I'm thinking about now, the whole reason I've started these videos is because I'm beginning with the teaching virtually and more online classes. I really feel like students don't get the same experience you get when you're in classroom and you're interacting with the professor. And so I felt that it was really a good idea, for at least for my students, that they get a personal connection with me, and that you can hear me describe all this stuff in layman's terms. You're not just reading it in the book and memorizing what the book says, because again, that's, you know, you're regurgitating information, so to speak, from the book. And you have to understand, you have to do all that because that's how you pass the class. But really, it's about having somebody explain some of this stuff and what does it really mean to you in your life and how do you apply it. And that's what I'm trying to do. If you like that, please make a comment in the comment section, subscribe to my channel, and let me know what other directions you want to go. And I'm going to continue working through this. I'm still in chapter 1, but thank you for watching.